What's going on, Lions and Wolves? I'm here back again to do a premium update video for you guys. I'm trying to do these as much as possible every week, but sometimes we just don't have enough data to give you guys a update. I do have a little bit of data now, so I want to share with you what I'm looking at in the market conditions here on this update for July 12th week. So mainly want to talk about how the rally for the S&P 500, QQQ, and the Dow Jones are pretty much heading into, the possible sector rotation here out of tech and then into other sectors, as well as we'll talk about Chinese equities, where they are, where we expect to go from here, and then I'll also wrap it up with some potential opportunities that I'm seeing in the markets right now for last-minute rallies. So let's get started and get this broken down as much as possible. So the S&P 500 here, we have been on a very nice wave of consolidation. This wave should be the biggest wave that we're going to see up to the upside. The 61.8 target is still intact here. That means our target's going to be close to the 439 level, reaching the 440, which will be seen maybe after a slight pullback and then extension here. We should be able to see this accomplished through the end of July. Definitely within the next few weeks we'll see this. Now, one thing that you have to note is where this market conditions are right now. We definitely do not want to be purchasing huge amounts of long-term shares here, right? Especially since capital valuations are much stretched from where they were. I pointed out earlier, as the S&P 500 PE ratio is creeping up to all-time high levels, and the S&P 500 dividend yields are at all-time lows, which means to say valuations are stretched, and investors will not reward this market with additional capital unless they see a risk-reward opportunity, and that risk-reward opportunity is slowly fading away. We can see that the upside here is now slightly limited versus the downside, which is far greater. Therefore, very quickly here, I just want to tell you guys that we are approaching a point in which we want to start to take downside positioning to protect our long-term positions. Okay. Now, like many of you know, I have a much bigger long-term portfolio which I hold shares, and I don't really trade that many options from time to time. What I see as swing trades, I take a very small percentage from my portfolio and play swing trades with it from time to time when I see very, very high success rate setups. And when I do take those trades, I ensure that I manage my risk and I get out very quickly. If I take a lotto position, I don't allocate more than 3% or something like that into it, and if it is a loss, it's a loss. I write it off, and that's all about it, right? Like recently we had one trade that went bad, which was Wish, right? And that option was expiring this week. I already closed it out and realized the loss on that one. It happens. If you're taking a lottery position, you're following unusual options activity, remember, it's never about just following blindly. We saw lots of possibility of a short squeeze, but it didn't actually happen. Market makers were aiming to squeeze the market out, and so they probably will end up rallying much later than what we anticipate. So we'll wait for the momentum to get back and then play those kinds of setups once again. But for right now, as I was mentioning, we don't want to chase this wave to the upside because we know that valuations are starting to get stretched. Now, you can see that it's even more obvious on QQQ here, where we're almost extending into the 61.8 extension, which is right above us here at the 365, right? And once we get to the 365, this will be a key level of resistance where we will see a possibility of supply come in. And if we do break that level, then it's 368 and beyond 370 before we see downside. So we do not know how this is going to perform, but from my perspective, we're already reaching a very, very considerable area where we will be considering to not take additional risk than we need. If you're playing momentum style trades in this market, you have to absolutely be only scalping and taking plays that are bounces in liquidity zones. For example, coming down into a zone where you see liquidity bounce and then you're just out within a couple of minutes, right? You don't want to be holding contracts throughout the whole day or swinging anything in this market. It's not really a good idea. However, there are some stocks that are presenting nice swing opportunities. And so those are different cases in which we see possibility of risk-reward ratios to the upside, and we will be alerting you when we see them. The Dow Jones, on the other hand, here is now starting to break out into all-time highs. So we are seeing a slight sector rotation out of money that is flowing out of SPY and QQQ that might possibly shift into the Dow Jones here. We saw Volume actually spiked 3 days ago, and now it's starting to fade. So we'll be watching this closely to see if the Dow can continue its rally. We have upside targets all the way up to 357 on the DIA, which is the proxy that we use for as the ETF for the Dow Jones Industrial Average. As I said, majority of these businesses now are starting to get extremely overbought. I'm not talking about just any other businesses. I'm talking about majority of the value stocks are seeing valuation growths that were expected and in line for this earnings season, which we have been anticipating. And we expect the earnings season this quarter to do better than expected. Financials will be leading the way today after market close and throughout this week. So we will be getting a good idea on where this market will be heading in terms of performance. Once we know financials, we will be able to tell how big tech and the rest of the market will more than likely end up performing. And I will do a separate video about that probably next week for the premium update to give you guys a breakdown on how these companies are performing for their earnings. So now when we compare all of this in contrast to the Chinese equity market, we can see that there is a huge divergence between the tech and S&P 500 in the US versus the Chinese markets. Now, I know many of you who have taken long positions in KWEB are hurting, and you're thinking, oh man, I've got myself into a terrible situation. The truth is, you can never time a bottom. You can never know where the bottom is. I started accumulating KWEB when we were here and here, right? And I have been adding on the dip whenever I see an opportunity, right? You can't tell when the bottom of a correction is going to be over. But what we do know is that this market is now down almost, I want to say 40-some% from the highs. It was 43%, and as of now, pre-market on this 13th of July, we are at 39%. So this market is down 40% from its highs, and this is mainly because of a fundamental reason and a difference between the U.S. and the Chinese monetary policy, right? When the U.S. monetary policy came into play when coronavirus striked, the Fed said, okay, we're going to provide you with adequate liquidity to get through the situation, and that's what has caused this huge rally, right? Continued cheap abundance of money supply. However, the Chinese government took a completely different route altogether. When the moment that they saw their economy becoming better, they tightened the monetary policy, causing majority of these tech companies in KWEB to go down in valuation. So we will be looking for a easement of monetary policy in the new month or in the coming months. And no matter what you say or you do, you never want to buy something when it is rallying, right? And majority of people always do that. They always wait, oh, I'm going to see it rallying and then I'm going to start buying it. But you're already too late by then, right? You want to buy when nobody's buying. Exactly these moments in the Chinese markets are where millionaires are made, right? It's when you run towards the blood. Nobody's picking this up. Nobody wants it. You pick it up at these dirt cheap prices and you ride the next bull wave to the upside, right? And obviously we don't know when is that going to happen, how is that going to happen, but we do know that eventually that will happen. So taking leap contracts or taking contracts that are 1 year expiry from now, or taking shares, right? For example, I own a lot of shares of KWEB. I have almost 100 shares of KWEB just as a ordinary position. And then I have on top of that leaps, right? Or rather longer term expiry contracts for KWEB. And when you do that, you're pretty much putting yourself in a position where you have levered down into a market that is going to see a reversion to the retracement, right? So if you were to take, that, okay, maybe this was the bottom or this was the bottom, let's say that, we take away from here to here, from the upside all the way down, and we do a Fibonacci retracement, right? And we say that this was the bottom. The reversion has to be somewhere around the 50% retracement, which is going to be around the 81.80 level, sometime in the next few months, right? That will be a very strong rally on the Chinese equity market, and we will see a correction at some point down the line. Now, one of the reasons why I'm very confident about this is because companies like Baba and other companies that we know about, they haven't fundamentally changed in their business structure. You need to understand this. See, the problem with disconnects in these markets are that the Chinese government decided to do a crackdown on these companies and say, oh, we don't want you to be monopolistic. And at the same time, they started removing companies and saying, oh, you're violating privacy laws and whatnot. Many people view these opportunities many people view these things as threats, right? And that's why they sell. They sell and they run away because they are scared of this very big opportunity that is presented in front of them. This is literally the moments that you wait for in the US stock market, like the equivalent of a coronavirus crash. You have to realize that the coronavirus crash that we got last year was a huge drop in the stock market, right? And how much of a drop was that? That was almost what was this? You know, we were at an all-time high situation, and we came down almost what, 10? No, it was more than 10%. I want to say it was definitely more than 10%. I want to say, wait, oh no, this is September. I'm sorry. Let's go back to, here we go. This is more like it, right? This was your Corona crash, right? And this was a equivalent of, from this high, a 35% crash, right? This is the equivalent of what is going on with the Chinese markets now because of valuations, and then a central bank which is tightening monetary policy when the economy is barely recovering. That opportunity is one of the biggest opportunities that you can receive in the longer term perspective. If you look at this chart, the Chinese market is so young, right? And you can see that we have a huge correction here, right? But if you look at this monthly chart, each one of these candles are months now, right? You can see that we are starting to enter the zone where it's a dual zone, right? This is the old resistance here, and now we're starting to find some support, right? We're starting to find some support. So how we close this month is going to be interesting, how we close July, and then how we get into August and the months beyond. We should see a uptick and a recovery in this market to the upside. It won't happen right away, but it will surely happen in the next 1 to 2 years. So therefore, having a long-term position in this market makes sense. Make sure that you don't go too out the money with your strikes neither, right? You want to take them such that there is a realistic amount of retracement if you're planning to get into this, okay? So I wanted to show you and put things in perspective for you. For people who are holding Chinese stock positions, you should not be fearful in this moment. You should actually be greedy in this moment. You should take this advantage of this positioning where everybody's selling to pick up these really cheap tech companies that are extremely well-to-do in China. Companies like Tencent, companies like Baba, companies like Baidu, right? These are all great companies that have solid economic moats, right? Even NIO as a business, right? It's a good competitor towards Tesla. Well, valuations of this business recovered quite a fair bit versus them, right? This one's listed in the NYSE. Companies like JD, right? Huge valuation discounts, things that you will not really imagine are doing well. PDD, right? Great companies, okay? And all of these are great investments for the long run. So if you don't want to pick and you don't want to choose which one you want, then we do the investments through KWEB. And at the same time, you don't want to put all your eggs in one basket. That's why my portfolio has a diversification towards Azure, which is pretty much like considered like the Dow Jones Industrial Average of China, right? So this thing is still in a strong uptrend. You can see, we have been moving into higher highs, and I will be holding these positions for a foreseeable future, right? When my options do start paying, what I'll be doing is rolling them out further, picking lower strikes, even solidifying my delta positions even better, and then playing that market, in a more efficient manner, okay? So these are a couple things you need to know. Now, the second half of this year is slated to be a continued shift and momentum of the economy's opening back up. Now, out of this, we expect definitely energy and financials to continue their rally. Energy I think energy has had some of its run, but I think it can continue to go higher by the end of the year if oil prices don't stabilize, all right? And at the same time, financials will still continue to go higher next year. So, where they are right now are still relatively in their cycle. They're slightly overvalued. We need them to come down a little bit more. But I do want to look at financials in the long run because they will be a very good positioning when interest rates taper talk definitely start to happen. I've mentioned this before. When we expect interest rates to rise in the future, financials will be the ones to benefit from this, okay? And then at that time, we will see a correction down from tech, because once interest rates expectations start to go up, then we have valuations for tech stocks to come down, and then we have bond yields also spiking at that moment. So it will be all in all happening, sometime in the second half of this year. As I mentioned before, I expect this wave up to be the biggest wave up in this year, followed by a slightly bigger, not so big, but maybe half of its size wave down into key levels of support before moving higher by the end of the year. So all in all, I think, right now, for example, the QQQ is up, I think something like 20-something% from the start of the year, right? If we were to take it from here where the start of the year was and we bring it to where we are right now, we're about 18.8%, right? And when we're talking about the end of this year, I think, we will end up somewhere within the 10 and 15% range by the end of the year with the QQQ, right? With SPY, we're probably projecting some numbers that are going to be, so with SPY, we are currently at, let's see here, we're currently at 19.83%, right? And I see the same thing happening in the SPY. I think we will probably correct after this huge wave up, we will correct downward, and we'll end up somewhere in the, probably 10 to 15 range, maybe even 15 to 20 range. There's a possibility if we can get strong earnings growth and strong economic rebound with unemployment strengthening, that will be the best case scenario for SPY and QQQ. Okay, great. So that's your macro update. Just wanted to calm any nerves that you guys have and give you guys realistic expectations here. Remember that this bull rally can keep going, but at the same time, remember not to be too exuberant about it. We've had a huge wave up. This will probably continue for another $10 or so at the maximum, and then we should get a correction to the downside before moving to the upside again by the end of the year. All right, cool. Now a couple of other opportunities here that I want to talk about that I'm watching and I want to update you guys about. So CRM is one of them that I want to talk about. I have a position in this for 250 calls. And, right now, this is, remember what I spoke about, ascending wedges are actually bearish positioning. And if CRM breaks below 240 here, I'm going to be cutting my position more than likely, okay? I don't like this price action that it is going through. I know market maker might be trying to pressure, but once it does cut below this 240 and so I will be cutting my risk at least by half. I don't want to hold such a heavy position. I allocated about 3% to this position, which is roughly about $3,000 from my options portfolio. And so I don't want to be holding so much risk into this setup when it is looking like a correction might occur. All right. So just a quick update on this position. CHWY, if you got into this one yesterday, I think it was a good entry. We might have to hold this for a little bit to see how it plays out. Consolidation might happen for a while, so don't expect things to happen right away, right? Then we have ROKU, which also was a great entry yesterday in my opinion, breaking out of the bull flag and might head higher. I told you guys into the 480 to 500. This goes along with our analysis on the ARK flow that we saw yesterday. Somebody was betting on a very big ARK fund move by, I think, the 23rd or the week after. And there was a $1.5 million bet for that, for like a $2 move or something like that. So we might expect a short-term rally in ROKU, Tesla, PayPal, the ARK fund stocks. That's something that you got to keep track of. Like PayPal is already starting to show signs of, breaking out and moving into all-time high territory. So watch these closely because these can definitely still move to the higher upsides. The momentum and the sheer amount of bull strength in these have been really, really interesting. Update on Boeing as well. Remember, more bad news here came out about FAA delaying something. But once again, this is a long-term leap position. This company is severely undervalued. Holding shares or leaps of this business is a great idea for a long-term investor. Remember, I'm not talking about momentum style. I'm talking about long-term investing. I've never ever mentioned Boeing as a momentum stock, and it has never been mentioned as a momentum stock. So I hope that you guys don't treat this as a momentum investment. Because yeah, it moves a lot when it moves, but remember that when it consolidates pretty hard as well. So you have to be very patient with these kinds of investments. You cannot just say, oh, I'm going to buy it today and expect 100% return tomorrow. Because this is not a stock that's going to return you 100% over 1 to 2 months. It's not like that. This is a stock that will return you 100% over 1 to 2 years maybe, right? And so being patient and letting it play out the way that it will is the best that you can do right now. So where we are, we bounced on a very strong demand zone. This was the bounce zone right here, and now we're starting to capture higher highs. We need to break above this key level at 245 or so, 244, and start to head higher here to the upside. A clean break above 252, right, which is this yellow line here. We'll see our start to inch up to the upside at 270s and 280s. Okay, so Boeing here is looking okay, but remember, still in a downtrend for now. Still, we cannot be biased. So this is still in a somewhat downtrend. If you look at the trend here, right, it's still in a downtrend. Okay, so keep your mind open, keep your mind non-biased. Okay, so this is your quick little update. Now once we start breaking out of here, then we'll see some bullish reversal, but for till then we're gonna keep our mind open and not be too biased about this. And then we have Disney, which rallied on some news about them increasing prices of subscription. This one has been a very exuberant rally, and I think this one might continue to rally. So watch this one today. I'm thinking that, you know, a potential target at 190 is open for a day trade. So play your upside accordingly and view that in any way that you will. Tesla, we spoke about this on the watch list, and I posted it on technicals for you guys on the Discord. So make sure that you guys are aware of this one. Definitely had a nice wave up since we posted it. Bounced strongly on the demand zone right here. And we need to break above this key level of resistance here at the 700s in order for this to go full bull mode. I would like to play this, you know, at the break of 700 sometime this week. If it does break 700, I will be interested in taking an upside position up to the 750s and 760s as a possible swing. And that will go hand in hand with the ARK Fund exuberance that we saw. Then we have Snow, which I think we missed the entry yesterday. That was a great entry. I think it was Jerome who was pointing it out during the market open. I was hoping that we would come down to 252, but we didn't really get that entry. The entry was at 258 yesterday. I kind of don't want to chase this just yet. I think that we might get that wave down. This is only about 2 candlesticks in, and you know, it still might give us a slight wave down before continuing to the upside. So let's wait patiently for this one to come down before entering for a swing trade. This is a great swing idea. Then we have also DoorDash, which is a ascending wedge pattern here. This might be a bearish trade in the future, so I'll keep a watch on this and keep you guys updated. But for now, nothing really developing here. And that's all I have for you guys. This is your H2 update along with your daily brief. So it kind of give you a perspective of everything in the second half of this year. And so yeah, let's just do a quick little conclusion and wrap things up. So mainly, we want to be looking at the second half of this year, thinking about only investing in businesses that are going to be around for the long run. So you don't really want to be putting your money in any of the big tech right now, right? Because many of them have had an exuberant run and priced in extremely good earnings for this season. We want to see how these companies kind of perform. And as I mentioned on Discord multiple times now, this is the wrong time to get exuberant and start buying aggressively. This is not the time. The right time was when we were screaming to buy aggressively a couple months back, right? And we were talking about, hey, the bull market's going to start now. The bull market's going to start now. And I was telling you guys, this is the dip. This is the dip. Buy the dip. Buy the dip. And we spoke about it multiple times before. Now, all of those positions, if you would have taken it, would have paid big time, right? And with exception of the Chinese stocks, obviously, right? Chinese stocks, we had a little bit of a hiccup because of monetary policy tightening and at the same time, Chinese government doing what they were doing, right? So that's one thing that you can't control, okay? So in the meantime, what you want to really do is concentrate your efforts on starting to accumulate cash. Close out positions that you think are overvalued. And if you have any doubts, comments, concerns, reach out to me. I'm always here for you guys. If you have long-term stocks and you're wondering if you should be taking profits on it, until and unless it's a business that is a growth stock and you are afraid of the valuation being a bit high, you should not be taking profits on anything, right? The strategy here is to lighten your position, free up some capital, just a little bit on growth stocks, sell those away, and then start to hedge your portfolio on this next wave up. Into this market strength that you see that we're about to go into right now, this is where you start picking up longer term puts and VIX options on your portfolio. And this way you will be prepared for when the dip comes and you can ride through the dip, cash out your puts, and then prepare yourself for the next bull wave that will be coming after the dip. Now we expect the dip to be sometime in August and September. This is what we are projecting, but we could be completely wrong, right? But this is the seasonal chart for the S&P 500. And so far we have been following the seasonal activity of the S&P 500. So the conclusion is, don't be exuberant here. Start to accumulate cash. Start to, on this up move here, start to hedge your portfolio and protect your gains to the downside, because the risk-reward ratio is becoming more skewed to the downside now. And that's how you really want to play this next wave. if you want, you can also start taking exuberant. You should be extremely greedy in Chinese equities right now. That's for sure, right? Valuations are all-time low. Like PE ratio in the Chinese market is way below the median. So take advantage of those valuations, but give everything else up. So thank you for listening to this video. Once again, if you haven't already, make sure you like this video and subscribe if you haven't. Thank you for watching it. Sorry for it being a little long, but it was a big update for you guys. So I hope that you guys enjoy it. And leave a comment if you found it useful, or you just want me to do another update on something else, or you have any ideas. Thank you, and I'll see y'all in the next update tomorrow on the Daily Brief.